American Airlines' new CEO says demand is as strong as they've ever seen it. We have all his comments from their latest earnings call. A new survey says more travelers are planning vacation this summer, and they're planning to take more trips as well. Southwest Airlines reports revenues are 91% recovered to 2019 levels and expects a complete recovery in the back half of the year. More on their forecast for business and leisure shortly. And we'll share some of the top tweets from today's travel industry influencers. I'm Tracy Lindley, and these are your travel industry headlines. American reported industry-leading passenger revenue of almost $8 billion in the first quarter. Their new CEO, Robert Isom, said demand was at record levels. And despite a large increase in fuel prices in March, the airline achieved its first monthly profit since last summer. Similar to other airlines, American saw a bounce back in corporate and international travel that's helping results. Operational performance also continues to improve, and the airline is hiring at a furious pace to prepare for peak summer travel. To avoid the delays and cancellations that plagued the airline last year, Isom says they've sized the airline for the personnel available. Let's hope so. Take a listen as Isom and his executive team share the results for the world's largest airline and their bullish outlook for the remainder of the year. Americans are planning lots of vacation this summer. That's according to a new survey from 𝐓𝐽𝐬𝐬. Following 2 years of pandemic, 63% of Americans say they're planning a summer getaway. That's up from 59% last year. Just over half of those surveyed say they'll take a long weekend vacation. But almost 40% said they'll travel 5 to 7 days, and 20% say their trip will last longer than a week. Millennials are the most likely to favor short getaways, such as a 2-night escape or a long weekend trip. And this summer, travelers also say they're planning to take more frequent vacations. Let's take a look at some of the data from the 𝐓𝐽𝐬𝐬 survey. One of the interesting insights from the study was that remote workers and those in hybrid schedules plan to travel more than average. While 63% of all travelers said they were planning a summer vacation, that number increases to 75% for those working remotely or hybrid. Similarly, 85% of travelers said they were planning more frequent vacation this year, while over 90% of remote and hybrid workers said they'd take more frequent vacation. The Great Work Reset and the merging of business and leisure travel have created more opportunities to travel. And the work from anywhere policies are starting to show up in the data. Hotel weekend occupancy rates are soaring, and leading leisure travel agencies report that higher prices are not slowing down bookings. It's a new world in leisure travel, and it's on full display this summer. Southwest CEO Bob Jordan reported they were surprised at how quickly demand bounced back. Following the plunge in Omicron cases, the company now expects record revenue in the second quarter. Strong leisure and business demand is straining the company's resources, and Jordan states that hiring is now their #1 priority. The company has already added 5,000 employees this year and expects to add over 10,000 by December. Also at the top of the airline's list is improving operational reliability and efficiency. Southwest's operation was devastated last year by staffing and weather-related disruptions, so the company is constraining capacity to avoid a recurrence of that disaster. Jordan expects it may be well into 2023 before Southwest can operate at 100%. Let's listen in as Southwest shares their results and the challenges they see in the months ahead.
Hello, everybody. Thank you for joining us today. Well, the first quarter was a tale of two really different environments. As expected, we incurred losses in January and February due to the negative impacts of the Omicron variant. We anticipated travel demand would rebound in March, and we were pleasantly surprised at how quickly it bounced back and the extent to which demand and bookings surged. While we reported a Q1 loss, we were solidly profitable in March, actually not too far off of March 2019's profit. And while modest, I'm very pleased that first quarter unit revenues increased as compared to 2019. That was the first quarterly increase since the onset of the pandemic. But for the Omicron impact, we would estimate that we would have been profitable for the first quarter. In the first quarter, total operating revenues were 91% restored to 2019 levels, despite Q1 managed business revenues being only 45% restored. Looking forward, we are very encouraged with the bookings and revenue trends we are experiencing for Q2, which indicate operating revenues will be fully restored to quarterly record levels on stronger leisure and business demand. Our revenue initiatives continue to roll out, and Andrew will cover our new fare product in more detail, but we look forward to launching that this quarter and getting another one of our revenue initiatives in place and producing value. Our March results and our current outlook for Q2 represent tremendous progress in our recovery. Even if we aren't fully expected to be optimized with our network fully restored until the end of next year, I'm just really proud of our people for their progress today. We've come a long way, and I'm just very thankful for their constant resilience. Now, key to our recovery is our continued hiring progress, and we now plan to hire and add over 10,000 new employees to the Southwest family this year, and that's net of expected attrition. By the end of this month, we will have welcomed roughly 6,500 new employees in 2022, and that's 5,000 net of attrition. And I'm just really pleased with our hiring progress. We continue to work through lower available staffing and training constraints to keep pace with rebounding travel demand, and we recently reduced our summer flight schedules to match our capacity guidance as we prioritize our operational reliability. I believe we have already accounted for the impact of staffing constraints in our full year 2022 guidance on capacity of down 4% versus 2019. But of course, if we need to trim more capacity, we certainly can, but I'm cautiously optimistic that we can get to a good balance of headcount to operate our planned flight schedules for the remainder of the year while setting ourselves up for resuming more material growth in 2023. You've heard me mention these things before, but we remain focused on a few key priorities for this year. First, getting properly staffed and focusing on our people. Second, making progress toward our historic operational reliability and efficiency. Third, providing our legendary hospitality. And fourth, returning to consistent profitability. You know, it takes all 59,000 employees working together to execute on these focus areas and deliver a low-cost, high-quality product with low fares and great customer service.
Looking first at Q1, January and February passenger revenues incurred two main negative impacts. First, $380 million due to softness in bookings and elevated passenger cancellations attributable to the Omicron variant. And second, an additional $50 million in January due to flight cancellations related to available staffing challenges, which were made worse by winter weather. However, we experienced a very different dynamic in March as we saw a surge in leisure travel and bookings, along with a significant pickup in close-in demand. The improvement in March exceeded our original expectations for both leisure and business demand. March managed business revenues were down 36% versus March 2019 compared to our latest guidance of down 40%, and put us back on a nice improvement trajectory from pre-Omicron performance in December of 2021. In fact, managed business revenues improved 34 points from January's down 70% to March's down 36%. We experienced higher managed business passengers, and most notably, March marked the first month since the pandemic began where managed business fares surpassed 2019 levels. Our revenue initiatives performed well during Q1, despite the Omicron impact. We saw benefits from our GDS initiative given the significant bounce back of business demand in March. We also had a strong performance from our loyalty program, with other revenue up 43% versus Q1 2019, which was assisted by incremental revenue from our new co-brand credit card agreement with Chase. A nice attribute from our new co-brand credit card agreement is that the revenue stream is rather insulated or diversified from the passenger revenue impact from COVID waves, as long as consumers' spending remains healthy. In Q1 retail sales, spend per cardholder and overall portfolio size continue to grow versus 2019. Looking at Q2, the positive momentum continues, and we're expecting operating revenues to turn positive versus Q2 2019, estimated to be up 8% to 12%, despite capacity below 2019 levels and managed business revenues yet to fully recover. As we were already operating at pre-pandemic load factors in the low to mid 80% range, our revenue improvement outlook is primarily due to higher passenger yields, both leisure and business. We expect another solid contribution from our revenue initiatives, in particular with GDS, as managed business revenues are expected to improve sequentially. April managed business revenues are expected to be down 30% versus April 2019, and we expect to see sequential improvement in May and June. In terms of network restoration, we will be roughly 80% restored by June based on trips. And based on our full year capacity guidance of down 4% versus 2019, we expect to be roughly 85% restored by December. As we have discussed, it will take us some time to rebuild the network that we want given current staffing constraints. But we will continue to expect to restore the vast majority of our network by the end of 2023.
And the first question will come from Ravi Shanker with Morgan Stanley. Please go ahead.
Thank you. Good afternoon, everyone. A quick question on the corporate side. Can you just give us a little more detail on what you expect the corporate ramp trajectory to be through the rest of the year into next year? And also, we're hearing from some corporate accounts that they expect a fair bit of competition in the second half of this year going into 23 when it comes to negotiating kind of just corporate travel agreements. Just given that we're kind of coming off this trough and everyone's going to be fighting for a slice of the pie. Do you have any visibility into that or not? Thank you.
Hey, Robbie, it's Bob. I'll start and then I'll let Andrew chime in on more of the specifics. I think while our managed business recovery has obviously lagged leisure. I mean, leisure is well ahead of 2019 at this point. We've seen a really robust recovery. So I think in March. We were down about 36% compared to 2019, but that's a 34-point recovery from January, which is just a really significant trend. It looks like April's going to be about 30, down 30, and I would expect that from what we can see, the trends continue to improve through May and then through June. And while it's a long ways away, it's all forecasts. I wouldn't put it out of the realm of possibility that we could have managed business revenues fully recovered to 2019 levels by the end of this year. But I'll let Andrew add some details as well. Andrew?
Yeah, thanks, Bob. The only thing I'd add to that initial macro point of view is if you kind of go back further than January and kind of April of last year when corporates really started traveling again, we have a nice, strong trend line, but it has some ups and downs with COVID waves. And so now that we're kind of out of Omicron and seeing a sharp comeback, it's still on that same trajectory, which leads one to believe that it will get to what Bob said. So we have pretty good confidence in this growth because it's grown and rebounded strongly through at least 2 COVID waves so far. So that's good news. And in regard to corporate contracts, a lot of them have become stale because there wasn't really a lot to renegotiate during the pandemic. So we fully expect there to be kind of a big season of renewal of contracts in the fall, as you mentioned. And given that during the period from pre-pandemic to now, we've greatly transformed our offering in managed business through both the GDS we've talked about, but also ramping up our Southwest business team with the tools for TMCs and CTMs, as well as more account managers. We think that kind of broad-based renewal is actually beneficial for us in our play for a bigger share of this pie. So we're encouraged by the renewal season coming up this fall.
We have time for one more question. And that question will come from Sheila Kahyaoglu with Jefferies. Please go ahead.
Hi, it's Scott on for Sheila. Just on that managed corporate down 30% in April, is there any way to maybe parse out how much of that is restoration of 2019 managed corporate revenue and how much is coming from taking share with these new revenue initiatives you've put in place?
Sure, which I'm going to disappoint you is that's part of our overall revenue initiatives, which we gave a benefit of $1.5 billion Investor Day, and we're not decomposing those individually. You can certainly take a look in the ARC data and see our increasing composition of ARC and what that means for us getting more and more business travel. But that restoration is a combination of what we had before and new stuff. The new stuff is really mostly share of wallet, if you will, for individual entities. So the people with whom we're doing business through the GDS, we were also doing business through our Direct Connect or Southwest Business SWABIZ application before. So it's really about giving them multiple ways to purchase from us, whatever distribution channel they prefer, and we're getting more of those accounts business as we've given them this option.
And the next question is from Kyle Arnold from the Dallas Morning News. Please go ahead.
Hey, thanks for taking my time, or taking some time. Have you made any more work, or is there anything specific you've done to solve some of the irregular operations problems? I know there's a report about a meeting in Florida, talk with the FAA about some of the issues happening in there. What all are you doing to make sure that, some of the either tech or the staffing or the compounding problems don't creep up again this summer?
We've been talking all morning long about our aggressive hiring plans, so adding people there. And then Andrew talked a little bit about us re-optimizing our aircraft flow and our design toward the shorter haul trips, and that's going to help our crew and our operational recovery. So we feel that those are the three big pieces that we're in a much better condition and place that we've been in as we move forward. We do have, as you mentioned, we do have specific, and when I say we, I mean the airline industry has specific impacts with respect to Florida air traffic control and travel through there, and it's a combination of problems down there. There's more commercial activity, there's more GA activity, there are more space shuttle launch. The weather patterns that go through there are complicating all of that additional traffic. And then I think that just like everyone else going through with staffing, the FAA is going through staffing challenges as well. So there is a focus, an industry focus on that. And in May, the FAA and some of the impacted carriers are going to talk about solutions to that specific airspace. So I think when you package all those things together, we're in a much better place going into this summer than we were last summer.
Thank you. And we have time for just one more question, and that question will come from Robert Silk from Travel Weekly. Please go ahead.
Are you all getting many calls or cancellation requests from individuals who are worried now that there's no mask mandate? And if so, are you allowing cancellations in those cases?
Robert, we watch our customer relations calls and questions every single day. I haven't seen a material rise in that at all. We survey our customers every single day, and I would just start with the percentage of customers that are comfortable flying just overall is very, very high. It's 90%, 90% plus. The second is we also survey how comfortable our customers are flying without masks. And that number is also very much in favor of our customers being comfortable. And just to mention on the mask, I'm very pleased for our employees and for our customers that they now have a choice. It's tough to wear the mask all day.
Time to take a look at some of the top travel tweets. Seema Modi with CNBC tweeted this following her interview with Marriott's CEO. Tony Capuano's bullish on the strength of the travel recovery despite the headwinds of rising interest rates, Ukraine, China's zero-COVID crackdown, and higher fuel prices. Marriott's seeing a significant recovery in groups and meetings. And business travel is improving as well, led by small and medium-sized businesses. In regard to the slow recovery in large company travel, Capuano stated, "Many of the big urban cities where those companies conduct business have been a little slower to open up." IATA tweeted that the recovery of air travel is in full swing, with global passengers up 76% in March and international up almost 300%. The one exception was China, where domestic air traffic was down almost 60% in March. IATA also took aim at the Netherlands for allowing Schiphol Airport to raise airport fees 40% and cancel flights due to a shortfall in staffing. Willie Walsh, IATA's Director General, stated, "To secure the recovery and its economic and social benefits, the immediate priority is for governments to have plans in place to meet expected demand this summer. Many people have waited 2 years for a summer holiday. It should not be ruined through lack of preparation." The CDC says travelers should continue to wear masks. This latest recommendation is meant to slow the spread of the current Omicron variant and applies to all public transportation. The CDC is also appealing the judge's ruling on April 18th that overturned the CDC's mask mandate. There's no word yet on the status of the appeal or if the CDC would actually impose mandates again if it won. Based on our observations, most travelers are enjoying their maskless flights and rides. It may be difficult to impose mandates again when most travelers are vaccinated and perceive little risk. Zach Griff, with The Points Guy, tweeted that Delta was clamping down on Sky Club access. They're putting in place new entry rules effective June 1st. In an effort to ease overcrowding, Delta will now limit access to 3 hours before your flight and prohibit arriving passengers from using the clubs. It's a good sign for the recovery, but may be bad news for some harried travelers. This summer is going to be crazy at the airports, and travelers will be looking for any port in the storm. But whether the restrictions actually ease overcrowding is another question. We'll know shortly. Brian Chesky, Airbnb's CEO, tweeted their impressive first quarter results. It was quite a turnaround for the home-share leader. Airbnb reported 102 million room nights booked and $1.5 billion in revenue for the January through March quarter. That was up 70% from last year. During the depths of the pandemic, Airbnb took drastic action, reducing staff, shedding non-core businesses, and raising cash. Like most businesses, Airbnb discovered they could do more with less. The business is healthy again and well-positioned as travelers extend their vacations this summer. And finally, Uber CEO Dara Khosrowshahi tweeted this picture from their New York office and said it's great to be back together. Many workers are ready to return to a professional office with colleagues again. But the work-from-home culture is entrenched after 2 years, and some aren't interested in returning. But as Uber apparently discovered, a free lunch can work wonders. Here's what happened this week in travel history. Hilton CEO Christopher Nassetta reports first quarter results and a much improved outlook for hospitality. We have all his comments and insights for you. U.S. major airlines are laser focused on improving staffing and reliability. We'll hear from the CEOs as they get ready for peak summer travel. Sabre reports strong growth in its GDS and IT bookings and believes it's ahead of the competition in its cloud migration and other technology. And the digitization of meetings and events has the industry looking at new opportunities to improve production and engagement. I'm Tracy Lindley, and these are your travel industry headlines. Hilton says demand is roaring back. On their recent earnings call, CEO Chris Nassetta stated that leisure demand remains strong and business and groups are returning quickly. Small business has led the recovery, but larger corporate clients are catching up now. And meetings that were disrupted in the first quarter due to the Omicron surge were mostly rescheduled. That wave of pent-up demand has the company expecting record revenues in the back half of the year. Hilton also says the efficiencies they found during the pandemic will boost margins going forward. Let's listen in as Nassetta discusses first quarter results and his expectations for the remainder of the year.
With recent performance exceeding our expectation, we were pleased to have resumed our capital return program earlier than anticipated, beginning share repurchases in March. Through April, we had completed approximately $265 million of buybacks. Additionally, we have declared a 15-cent per share quarterly dividend, further highlighting the confidence in continued recovery and the strength of our model. For the year, we expect to return $1.4 billion to $1.8 billion to shareholders in the form of buybacks and dividends. Turning to results, in the quarter, system-wide RevPAR increased more than 80% year over year, driving adjusted EBITDA up 126%. RevPAR was approximately 83% of 2019 levels, with adjusted EBITDA at 90%. Despite a choppy start to the year, given Omicron-related demand pressures, trends picked up meaningfully month over month, with RevPAR declines versus 2019 improving approximately 17 percentage points from January to March, down only 9% to 2019, driven by acceleration across all segments. In March, system-wide rates were up 3% compared to 2019. Strong leisure transient trends continued to boost weekend performance, with RevPAR in the quarter exceeding 2019 levels and rates up approximately 9% versus prior peaks. Acceleration in business transient and group trends drove meaningful improvement midweek. U.S. business transient RevPAR increased sequentially versus the fourth quarter, with March down only 9% compared to 2019 levels. Improving trends from large accounts along with continued strength from SMEs boosted results. In March, revenue from large accounts was just 12% below 2019. Overall business transient now comprises 45% of total segment mix, just 10 points shy of pre-pandemic levels. For April, overall U.S. transient booked revenue for all future periods was up 17% versus 2019 levels, with rates up 10% and room nights up 7%. Weekday booked revenue was up 9% compared to 2019, and weekend booked revenue was up 38%, driven largely by strong rate gains. On the group side, social and smaller events continued to lead recovery, while demand for company meetings and conventions improved meaningfully throughout the quarter. In March, total group RevPAR was more than 75% of 2019 levels, improving approximately 25 points versus January. Additionally, group revenue booked in the first quarter for all future periods was down just 4% relative to 2019 levels, and total lead volume for all future periods was up 3.5%. Compared to 2019, our tentative booking revenue is up significantly, with rate gains for company meetings up more than 13%. Additionally, rates on new group bookings for in-year arrivals are strong, up in the high single digits versus 2019. As we look to the balance of the year, we remain optimistic. Positive momentum has continued into the second quarter, with April RevPAR tracking at roughly 95% of 2019 levels. While macro risks and uncertainty exist, forecasts for economic growth remain healthy. Additionally, our ability to reprice rooms in real time creates a natural inflation hedge. We think there is a good likelihood that we'll reach 2019 system-wide RevPAR levels during the third quarter. For the full year, we expect leisure RevPAR to exceed 2019 peak levels given excess consumer savings, a strong job market, and pent-up demand. We expect business transient to be roughly back to 2019 levels by year-end, with expectations supported by rising corporate profits, rebounding demand from big businesses, and loosening travel restrictions. On the group side, we expect RevPAR to be at approximately 90% of 2019 levels by year-end as demand for company meetings and convention business accelerates into the back half of the year. On the development front, our leading RevPAR index premiums and powerful commercial engines continue to drive out performance. In the quarter, we added more than 13,000 rooms and achieved 5% net unit growth. We continued to deliver on our commitment to discipline and strategic growth, celebrating important milestones across segments and geographies. We opened our 500th Homewood in the U.S., our 50th Hilton Garden Inn in Asia Pacific, and debuted our largest hotel in the Asia Pacific region with the opening of the 1,080-room Hilton Singapore Orchard. With a contemporary design, innovative dining experiences, and extensive meeting space, the property is a fantastic representation of our flagship brand and puts us in an even stronger position in Asia to usher in a new era of travel. Building on last quarter's momentum, we also continued expanding our lifestyle portfolio with the openings of the Canopy Boston Downtown and the Canopy New Orleans. Even with strong openings, we grew our pipeline to more than 410,000 rooms, up year over year and versus the fourth quarter. We continued to lead the industry in new development signings, with Home2 Suites surpassing all other competitor brands globally. We demonstrated our commitment to further expand our luxury and lifestyle portfolios in the world's most sought-after destinations with the signing of the Waldorf Astoria Sydney, the Conrad Austin Hotel and Residences, and Canopy properties in Cannes and downtown Nashville. We look forward to delivering world-class service and unforgettable experiences in these exciting destinations. Conversion signings in the quarter were up 15% year over year and represented nearly 20% of overall signings. In recent months, we signed agreements to bring our conversion-friendly brands Curio and Tapestry to exciting destinations like the Galapagos Islands, San Sebastian, Spain, Maui, and Sonoma County, California. DoubleTree has continued to lead the way for European upscale growth with new conversion properties across France, Germany, and the Netherlands. While rising costs are pressuring construction starts, we are on track to deliver 5% net unit growth for the year and remain confident in our ability to return to a 6 to 7% growth rate over the next few years. Reliable and friendly service are at the heart of our promise to our guests, and we continue to leverage our direct channels to offer them even more personalized experiences. Direct bookings continued to grow in the quarter and represent roughly 75% of our total bookings, led by growth in digital direct. OTA mix continued to decline and is approaching pre-pandemic levels as increases in business transient and group demand shifted customer mix. In the quarter, Hilton Honors membership grew 15% to more than 133 million members. Honors members accounted for 60% of occupancy, flat versus the first quarter of 2019, and average nights per member were up 11% year over year as engagement continued to grow.
And the first question will be from Joe Greff from J.P. Morgan. Please go ahead.
Good morning, everyone.
Morning, Joe.
Chris, how much of your second quarter and full year RevPAR guidance is occupancy driven versus rate driven? How does moderating growth in leisure volumes, just given the tough comparisons, and relatively higher growth in business transient group volumes impact the blend of ADR and ADR growth in the second half?
I think as the year goes on, we expect the largest part of RevPAR growth to come from rate growth. We obviously expect to see occupancy growth as well, but I think net it will be majority driven by rate. In terms of the segments, leisure broadly remains quite strong. I mean, right now I think the number is, consumers still have $2.5 trillion of excess savings that they accumulated during the pandemic in their pockets, while people have been out traveling a lot more than they had maybe a year ago. There's still a lot of people that haven't, and a lot of people that really want to get out and have experiences. And so, people that we have pretty full employment, people have a lot of money in their bank accounts, and I think now feel quite safe broadly, certainly here in the U.S. Not everywhere in the world. Obviously, the world's a big place, but in the Western world, feel safe going out. Group side lags a little bit, as we know. There's more planning involved in that, but we think the second half of the year is going to get stronger and stronger. And business transient, even over the last couple of months, we've seen pick up, and notably, and something I commented on in my prepared remarks, we've even seen the large corporates start to come back, where March was only 12% down, and April, you can assume was better. We don't have all the data on the breakdown in April, but certainly broadly, business transient was even better in April. So, businesses have a lot of pent-up demand, needs for travel, balance sheets are very, very strong, profits are very strong, liquidity is very, very strong. And so I think, the combination of that with what's going on with the consumer, and then sort of the icing on the cake is the group side, where there's just so much new demand, but then pent-up demand, all of which, I think will start to converge here in the second half of this year and into next year, I think puts us in a place where we feel really good about the short to intermediate term, and both the demand side, but particularly the rate side.
And the next question will be from Carlos Santarelli from Deutsche Bank. Please go ahead.
Hey, everybody. Thank you. Chris, you talked a little bit about kind of business transient back at 45%, versus, I believe that was probably closer to 55 pre-pandemic. And obviously group is probably a couple hundred basis points below its normal mix. As that stuff comes back and you think about maybe a full year 2023 and occupancy in general, what kind of pricing power do you think you have at occupancy levels that are kind of commensurate with 2019 levels, which I believe were kind of 143, 144-ish?
Yeah. Well, first, in terms of the mix, it's probably worth stating because I commented a teeny bit on my prepared comments. You're right. Business transient, sort of the mix pre-COVID was plus or minus 55 business transient, 25 leisure transient, and 20 group. If you look at sort of what I would sort of call the bottom of the recession driven by the pandemic, it went to 35 business transient, 55 leisure, and 10 group. Now it's 45 business transient, 39 leisure, and 16 group. And I've been saying this, so pretty much for 2 years. In the beginning, people maybe thought I was crazy, but that when we wake up and this sort of flushes through the system and we get fully on the other side of it, that business mix is going to look an awful lot like it did pre-COVID, and I think we're on our way to that. And so I think when we look, maybe not now, I think leisure transient will probably remain elevated for a while, but I think it is regressing to the mean, and it will look more like it did than like it has looked in 23 and certainly in 24. I think we'll have meaningful pricing power next year just because the laws of supply and demand suggest we should, and I think they're alive and well.
The next question is from Robin Farley from UBS.
On the OTA business, the distribution mix, you mentioned it was down, which makes sense as business transient comes back. Was that, 15%? You mentioned 85% direct, which I assume includes, I guess, GDS.
75% direct. We didn't give an OTA percentage. We typically wouldn't. But we were in sort of the pre-pandemic, we were in the very low teens, which is what we sort of believe the efficient frontier is for the business to be able to drive the best results for our ownership community. And I would say in the quarter, we're basically there, plus or minus.
Airlines are struggling to staff for peak summer travel. In the latest round of CEO calls, all the U.S. major airlines discussed their hiring efforts. They're recruiting thousands of employees across the business, from pilots to gate agents to ramp workers. It's a historic challenge as they work to replace employees that took early retirement or were laid off during the pandemic. Each successive virus wave has wreaked havoc with airline hiring and operations. But they say they've learned their lessons and are only flying schedules that are appropriately staffed. That's great for reliability, but probably means fares are headed higher. Let's listen in as the airline CEOs discuss their plans and expectations for the busy summer season.
Now, key to our recovery is our continued hiring progress, and we now plan to hire and add over 10,000 new employees to the Southwest family this year, and that's net of expected attrition. By the end of this month, we will have welcomed roughly 6,500 new employees in 2022, and that's 5,000 net of attrition. And I'm just really pleased with our hiring progress. We continue to work through lower available staffing and training constraints to keep pace with rebounding travel demand, and we recently reduced our summer flight schedules to match our capacity guidance as we prioritize our operational reliability. I believe we have already accounted for the impact of staffing constraints in our full year 2022 guidance on capacity of down 4% versus 2019. But of course, if we need to trim more capacity, we certainly can, but I'm cautiously optimistic that we can get to a good balance of headcount to operate our planned flight schedules for the remainder of the year while setting ourselves up for resuming more material growth in 2023.
United increasingly is where employees, including airline pilots, want to build a career. They see the lucrative financial opportunities that I just mentioned, but they also recognize that United is an airline where they can be proud to work. From running a consistently top-tier operation to exciting new investments in our customers' experience to supersonic aircraft orders to being a force for good in the communities we serve, we're building an airline that leads, and that is where the best in the industry want to build a long-term career. In fact, we now see a lot of pilots from other airlines applying to be pilots at United, and that's new behavior. While we are in a good position for the smaller and mid-tier airlines, there just aren't enough pilots to staff their growth aspirations. The other really large airlines will also probably be able to attract enough pilots, but for anyone else, I just don't think it's mathematically possible to meet the pilot demand for the capacity plans that are out there. You can already see the issues that are occurring at multiple smaller and mid-tier airlines over pilot shortages. And looking forward, when United alone is ramping up to hire about 200 pilots per month, that situation is only going to get worse. This is not a temporary issue. Because of that, I now think the domestic TRASM environment is going to be much stronger in the years to come than we previously thought, because supply is going to be constrained by lack of pilots.
Running a reliable operation this summer will be critical to the continued recovery, and we have taken numerous steps to ensure we are well prepared to deliver for our customers. Our summer planning began last year as demand returned, and we haven't slowed down. American has 12,000 more team members in place to support the operation this summer than in the summer of 2021. We've already welcomed more than 600 new pilots this year, exceeding our goal, and we will continue to aggressively recruit, hire, and train across all departments to develop the best pipeline of talent in the industry. We're ready for the summer, and we have sized the airline for the resources we have available. Again, we've sized the airline for the resources that we have available. We've also made targeted investments in people, technology, and resources that are yielding promising results for our team members and customers.
Sabre says its technology transformation has it well positioned for the recovery. On their recent earnings call, CEO Sean Menke and new president Kurt Eckert reported improving bookings across the GDS and IT businesses. As global travel restrictions have lifted, bookings have accelerated. Hospitality has led the recovery, followed by air. Sabre's particularly dependent on international air bookings with higher booking fees, and that segment is beginning to improve. Throughout the pandemic, Sabre continued to invest in its Google Cloud partnership, NDC capabilities, and integration of low-cost carrier content. The company believes its cloud migration is ahead of the competition and expects that to provide faster time to market, reduced latency, and lower cost of development going forward. Here's Menke and the Sabre executive team discussing the pace of their technology investment and the improved outlook.
Good morning, everyone, and thank you for joining us today. It is no secret that the past 2 years have been a difficult period for the entire global travel ecosystem in which we reside. The beginning of the year was a continuation of those headwinds, driven in large part by the rise in Omicron variant cases. Yet, as history has shown, when we see a decline in COVID-19 cases and restrictions are lifted, travel recovery can be robust. Since the decline in COVID-19 cases earlier this year, we have been increasingly encouraged by the trajectory of our business and have seen consistent sequential improvement in each of our key volume metrics week over week since January. Travel trends are improving globally, and our business mix is normalizing towards pre-pandemic levels, resulting in higher unit profitability. The recovery, which has historically been driven by domestic leisure travel, is being supported by strong improvements in both international and corporate travel. Accelerating activity in each of these sectors made April our best month compared to 2019 in terms of bookings recovery since the onset of the COVID-19 pandemic. Recent forecasts by several airlines and travel agencies have been bullish regarding the outlook for travel recovery, supporting the trends we are seeing. Additionally, we are making solid progress towards our technology transformation, which remains on schedule to deliver expected significant savings by 2025. We believe our technology transformation will be one of the primary facilitators of higher margins and cash flow for Sabre when completed. Bottom line, we are more bullish about Sabre's near-term recovery outlook than at any point since the pandemic started, and our medium-term outlook continues to suggest the opportunity to drive EBITDA margin, operating income, and free cash flow higher than 2019 levels. In April, our key metrics, namely distribution gross air bookings, IT solutions passengers boarded, and hospitality gross CRS transactions, were all at the highest level of recovery versus 2019 since the COVID-19 pandemic started. March 2022 was the second best month compared to 2019. Hotel CRS transactions continue to lead, and in April were 112% compared to the same period in 2019. On the same hotel basis, community CRS transaction volumes in April were about 82% of 2019. IT solutions passengers boarded have recovered 80% in April versus the same period in 2019. Finally, distribution gross bookings recovery was 53% in April versus the same period in 2019. If we look at Sabre and the GDS industry recovery, excluding Expedia in both periods, our distribution gross bookings recovery in April was 64%, slightly better than the industry for the month. Domestic leisure travel continues to lead the recovery. In April, with the data through the 24th, the gap between the recovery in corporate travel management company bookings and non-TMC bookings was largest in domestic markets at about 7 percentage points. However, the overall recovery percentage versus 2019 was also greatest in domestic market for both managed corporate at about 66% and leisure travel at about 73%. International travel has recovered to about 58% of 2019, with short-haul travel the least recovered due to a slower recovery in Asia Pacific. The chart on the left shows the bookings recovery of domestic travel since the beginning of 2021, booked through corporate TMCs and other domestic bookings, which largely represent leisure travel. As I have indicated earlier, domestic leisure travel has recovered more significantly than corporate. However, as the graph on the right details, the difference in the recovery between corporate and leisure has narrowed significantly as corporate travel has accelerated. We're also happy about what we are seeing in terms of the breadth of the corporate recovery from a sector perspective. Though still below the total recovery of most other sectors, the financial, consulting, and IT sectors, which are historically heavy travelers, ended Q1 accelerating rapidly, faster than at any point since the pandemic started. These sectors also ended the quarter at their highest levels of overall recovery since the pandemic began. As you'd expect, airlines around the world have been trying to match their flight schedules with anticipated demand while factoring in potential global travel restrictions. This approach resulted in a capacity mix which was heavily skewed towards domestic capacity, which is less profitable for Sabre, and away from international capacity, which is more profitable for Sabre. However, we are now beginning to see this reverse back towards pre-COVID-19 pandemic capacity mix as borders reopen and testing requirements are loosened or removed. With the exception of Russia, all of our top countries in North America, Latin America, and EMEA are more than 50% recovered. Countries in the Asia Pacific region generally continue to be slower to recover than the rest of the world, but even there we are seeing improvements. The second takeaway is that as travel restrictions are reduced, bookings tend to accelerate very quickly. We've noted this effect on prior earnings calls, but the data for Australia is another example. On February 7th, Australia announced it would reopen to tourists starting February 21st. Quickly, the bookings recovery in Australia went from 34% of 2019 on January 31st to 66% by mid-March to 82% by April 18th. I'll conclude where I started. Travel trends are improving globally, and our business mix is normalizing towards pre-pandemic levels, resulting in higher unit profitability. Based on the most recent trends, we are optimistic about the outlook for our business and continued recovery.
On last quarter's earnings call, we described how our technology transformation, including mainframe offload and migration to Google Cloud, is expected to drive a strong return on investment of over 30% and an NPV north of $300 million. We also detailed how the tech transformation is expected to prevent a 50% increase in hosting costs and enable the avoidance of large capital expenditures to refresh our servers and data centers. Finally, and perhaps more importantly, we highlighted the many product enhancements the tech transformation is expected to unlock, including faster time to market, enhanced stability and security, a globally distributed cloud footprint, reduced latency, easier customer deployments, and lower cost of development. I am pleased with the progress we made in the first quarter toward our 2022 technology milestones, and our tech transformation remains on track to achieve stated goals by the end of 2024. As a reminder, our two key technology milestones for 2022 are to exit our Sabre managed data centers and migrate to the Google Cloud, and to offload passenger name record, a customer reservations database, from the mainframe to Google Cloud. Specifically in the first quarter, we increased our travel agency shopping volumes in Google Cloud from about 5% at the start of 2022 to about 50-50 between Google Cloud and AWS by the end of the quarter. Additionally, all airline shopping is now on Google Cloud. In the first quarter, we also launched new Google Cloud regions in Australia and Singapore, enhancing our global footprint and allowing for faster response times. Finally, we increased our share of servers on Google Cloud by 10 percentage points since the fourth quarter of 2021. As of March 31st, we had 28% of our total servers in Google Cloud Platform and expect to end the year with 65% of servers in Google Cloud and 90% of servers in a public cloud.
Our first question comes from Matthew Broome with Mizuho. Your line is now open.
Going forward, do you expect the corporate and leisure recoveries to sort of move in lockstep with each other now, or is there any chance that they diverge again? In other words, do you expect corporate volume to sort of complete its recovery in the same time frame as leisure travel?
Yeah, Matthew, I'll kick this off, and thanks for joining us. I think the encouraging thing that we're seeing right now is we talk about really over the last, call it year and a half, what we've seen on the leisure side of the equation. As we look at corporate travel right now, yes, we're encouraged, but I think the underlying piece of this is that corporations are happy to have their employees back on the road, and that's a very important step. Is that taking place? So, as long as we do not see any other sort of cases of a COVID outbreak, we believe that the momentum is there. The discussions that we have with the travel management companies, as well as, some of the details that we're providing relative to specific sectors within the business marketplace, it's all moving towards getting on the road more. So unless there's a hiccup relative to, more COVID cases, I think we're moving towards, recovery. And it's one thing that we've talked about as it relates to really the short-term investment opportunity for Sabre is playing the recovery side.
Our next question comes from Mark Moerdler with Bernstein Research. Your line is now open.
How does inflation and rising fuel costs theoretically affect volume recovery, or does it not?
Well, one thing to point out, as it relates, and let's focus on sort of Sabre. If you look at bookings, because a lot of this comes back to bookings and what's happening with bookings. Just a reminder for everybody, the price of the ticket does not impact Sabre. It's really the number of transactions that are taking place. I think the one thing that I focus on, Mark, and it does go back to why we look at the capacity and we look at what's happening with bookings. We're still, if you go back to the fourth quarter of 2021, the first quarter of this year, total market recovery globally was only 50%. So I believe there's a lot more room for essentially recovery as it relates to that.
Our next question comes from Jed Kelly with Oppenheimer. Your line is now open.
Just wondering your thoughts on how you're viewing some of the consolidation or among the low-cost carriers that we're beginning to see and how it could impact your business moving forward.
Well, I think the only consolidation that we're seeing in low-cost carriers is the proposed, Frontier, Spirit, or I guess it was changed yesterday, the Spirit JetBlue. Again, if we look at it, relative to what's taking place, I don't see a large impact whatsoever. Some of them use our technology, others of them use competitor technology. I think this is a unique thing here in the United States, and again, it's here in the United States, but we think very globally.
Our next question comes from Josh Baer with Morgan Stanley. Your line is now open.
I think last quarter we actually talked about the underlying assumption for a 90% recovery in corporate embedded in those targets and the rest spilling over to leisure. Just wanted to confirm that was the right level and the right level for all three of the 2025 scenarios.
Yeah, again, as we look at this, Josh, it's based on, our best prediction of what the future is going to be, and what we, see. I mean, the one thing that we're seeing right now, as it relates to corporate recovery is probably a little bit stronger than we would have expected. So again, those are the assumptions, and, as we stand at this point in time, that's where we will keep them for the forward guidance of where we'll land in 2025 as we get more information. And, we've been very focused on providing information. We can make those adjustments, but we feel comfortable with where we set those estimates as well as those volumes into the future.
Okay, so it is 90%, embedded in your assumption is 90% corporate recovery across all three scenarios?
Yes, sorry.
Okay.
Pandemic technology advances have forever changed meetings and events, but the new virtual and hybrid formats across webinars, conferences, trade shows, and customer groups are challenging the industry to keep pace. In a recent report from the CMO Council and 𝐓𝐶vent, 64% of marketers say they were moderately effective or not effective at executing virtual events. That's not surprising, as the rapid onset of the pandemic left little time to optimize the format and approach for fully digital events. Many companies are reporting virtual fatigue or the loss of engagement from virtual audiences. But that doesn't mean virtual events aren't valuable. Virtual events can create value in new ways, such as monetizing global audiences via on-demand viewing, well beyond the actual event. Going forward, planners will need to better integrate critical technologies into in-person events. That includes web and mobile platforms, on-demand content, and options for digital and in-person audiences to connect with each other. It will take time to fully integrate these tools, break down marketing and technology silos, and realize their full potential. But we're well on our way. According to the CMO Council, 71% of marketers are already experimenting with new event formats. The pandemic may be leaving, but the digitization of meetings and events is here to stay. The industry needs to embrace the new technologies as a core competency. Here's what happened this week in travel history.
Time to take a look at this week's top travel tweets from some of the most followed journalists and influencers in global travel. Brian Chesky, CEO at Airbnb, tweeted out a short video detailing changes to their app. Chesky called the new release the biggest in a decade. The new design helps users navigate through properties by placing them in curated categories such as design, farms, amazing pools, etc. It's meant to inspire people to try new locations and new properties. The home sharing company also introduced split stay functionality that allows travelers to split their trip between two different homes when the trip is a week or longer. Airbnb also recently announced their first quarter bookings were up 30% versus 2019. They are doing a lot of things right. Edward Russell with Skift and Airline Weekly tweeted that higher jet fuel prices in New York Harbor were enabling Delta to almost mint money at its Trainer refinery. Delta purchased the refinery back in 2012 to hedge its fuel costs. Since then, the refinery's returns have been limited. But with global fuel prices spiking, the investment is paying off in a big way. In the first quarter, the refinery generated revenue of $1.2 billion, a massive increase over just $48 million in the first quarter 2019. Delta's CFO says the refinery acts as a hedge on about 40% to 50% of the airline's fuel cost. 10 years ago, many questioned why Delta was acquiring a refinery. No one's asking any questions today. Boom Supersonic tweeted news about its partnership with the U.S. Air Force. Boom's mission is to reintroduce supersonic flight with fully sustainable technology. The partnership is with Air Force Ventures, which functions as an early-stage investor to accelerate commercialization of promising technologies. Via the partnership, the Air Force will match $30 million in research and development funding. Lots of technology moves from the military into the private sector over time. But in this instance, the private sector technology is moving into the military, an interesting twist. The Points Guy tweeted that new TSA technology could help reduce lines at the airport this summer. The new technology means TSA officers can review a 3D image of passengers' bags, reducing the need to physically search a bag's contents. And passengers screened in lanes with the new technology don't need to remove liquids or electronics. That'll further speed up the time to get through security. Good news in time for Memorial Day and a summer travel boom. And finally, Reuters shared this story about an American stuck in China for 65 days. Laura Hudson, a schoolteacher, quit her job in March just before her city went into lockdown. With the strict COVID policies in China, she was confined to her apartment for almost 2 months and spent her time writing a book and trying to figure out where to buy food. The World Health Organization recently stated that Chinese lockdowns related to their zero COVID policy weren't sustainable. That was not appreciated by the Chinese Communist Party. They call the WHO comments irresponsible and censored the comments from their media. Inbound and outbound China travel is still just a fraction of what it was pre-pandemic. U.S. travel indicators are holding steady as we head into summer. Airline traffic is still down about 10% from pre-pandemic levels. Office occupancy, a leading indicator of business travel, remains low and virus cases are rising again. But none of that seems to be holding travel back as we roar into summer. Let's take a look at some of the data. Here's the latest passenger data from the U.S. Transportation Security Administration. 2021 and 2022 numbers are shown in orange and 2019 passenger counts are in blue. The 7-day rolling average is now down 11% from 2019 levels. That's at almost the same level as last week, but forward booking data suggests that gap may close soon. Delta, United, and American all stated demand was as strong as they've ever seen it. Virus cases are down 90% from the peak of the Omicron wave in mid-January, and fewer travelers have health concerns. But the latest variant has case counts rising again. Versus last week, cases were up 27%, but that's on a very low base. Fortunately, deaths and hospitalizations remain at very low levels. U.S. office occupancy rates, a leading indicator of business travel recovery, are stuck at about 43%. While they're up from earlier in the year, they are not improving quickly. With the tight labor market, many companies have had difficulty getting workers into the office. That's not going to change anytime soon. But the story is different by U.S. region. Texas, with its more aggressive reopenings and business culture, is leading the country in occupancy. Austin is at the top of the list at 60%, followed by Houston and Dallas, both over 50%. The average office occupancy in the country is 43%. At the bottom of the list are San Jose, San Francisco, and New York, all still below 40% occupancy. U.S. vaccination rates have leveled off now with 220 million, or 66% of the U.S. population vaccinated. Seniors 65 years and older, the most vulnerable segment, are 91% fully vaccinated. That all builds confidence for long-delayed family reunions, vacations, and meetings and events. Medical experts believe the high vaccination rates and a wide base of natural immunity will also reduce the impact of the latest Omicron variant. Based on the strong sales data reported by U.S. Airlines, traffic should see a significant bounce back this summer. We forecast that U.S. airline passengers will be down just 5% by the end of May, and then reach, if not exceed, 2019 levels this summer. Massive pent-up demand along with record consumer savings are fueling a strong summer travel season. We'll update our forecast each week as more data becomes available.
Marriott reports first quarter results and shares the outlook for the world's largest hotel chain. We've got all the CEO's comments shortly. Uber says rides are up as workers return to the office and mask mandates fall. Travel Twitter is heating up as we head into the busy summer season. We'll share some of the top tweets this week from travel industry journalists and influencers. And finally, we'll look back at this week in 1927 and the transatlantic flight of Charles Lindbergh, a flight that changed the public opinion on air travel. What a moment. I'm Tracy Lindley, and these are your travel industry headlines. Marriott CEO Tony Capuano is pleased with how quickly global travel is returning. During the first quarter, Marriott saw the largest surge in global demand since the pandemic began in 2020. Worldwide occupancy rose from 45% in January to 64% in March. That's just 10 points below pre-pandemic occupancy levels. Revenue per available room, or RevPAR, improved in all regions except China, where the zero-COVID policy is stifling travel. But in the rest of the world, things are taking off. Following a lull at the beginning of the year due to Omicron, group bookings are increasing rapidly, and business travel is also recovering. Business travel growth is being led by small and medium-sized businesses. Capuano stated that many of the big urban cities where large companies conduct business have been slower to open up. Take a listen as Capuano and the Marriott executive team discuss their results and the outlook for hospitality. Uber CEO Dara Khosrowshahi says rides are accelerating. The rideshare giant reported $26 billion in gross bookings in the first quarter, up 35% versus last year. Rides were up 58% versus last year, and deliveries were up 12%. But the company also reported a huge net loss of $6 billion. That was driven by a $5.6 billion decline in the value of several of their equity investments, including Grab, Aurora, and Didi. Uber's shares were down on that news, even though gross bookings in April exceeded 2019 levels across all regions. As workers return to the office and mask mandates roll off, riders and drivers are returning to the service. Khosrowshahi also believes that Uber's broader platform that includes food delivery and shopping services will be more attractive to customers over time. Khosrowshahi says they're turning riders into eaters, eaters into shoppers, and shoppers into members. Let's listen in as Uber's CEO discusses their latest results and the outlook for the world's largest rideshare business.
Time to take a look at this week's top travel tweets from some of the most followed journalists and influencers in global travel. The FAA tweeted out the latest unruly passenger numbers. Fortunately, keeps falling after mask mandates were removed. As of the first week in March, it was just 1.7 unruly passengers per 10,000 flights. That's lower than it was before the pandemic began, as shown by the dotted line at the bottom of the chart. Unruly passengers peaked in early 2021 at about 13 per 10,000 flights when masks were first mandated. And although it got a lot of press coverage, the actual number of unruly passengers was very small. 99.99% of travelers wore their masks and didn't create any problems. Giving passengers a choice of wearing or not wearing masks hopefully puts an end to the unruly passenger era. Leslie Josephs with CNBC shared that all was not well with JetBlue and its flight attendants union. The flight attendants union announced it was withholding its endorsement of JetBlue's proposed Spirit Airlines acquisition. Their stated rationale was that JetBlue is an abusive employer and refuses to abide by its union contracts. The union also believes JetBlue will eliminate jobs and routes as the airlines consolidate. JetBlue management fired back that the union's complaints were disingenuous and meant to pressure the airline to renegotiate their contract. If the acquisition goes through, expect JetBlue and its unions to find a path forward. Spirit's flight attendants already approved the deal as it will significantly improve their pay and benefits. Bill LeBeau with CNBC shared that EV battery costs may increase 22% over the next few years as a result of raw material shortages. The primary issue is the soaring demand for lithium, which is needed to make tens of millions of batteries. Rising battery costs are expected to increase the price of an electric vehicle by $1,500 to $3,000. That has some analysts decreasing their projected EV sales volumes. There is a tsunami of electric vehicle demand coming, and battery manufacturers will have a hard time keeping pace. IATA tweeted an update from their Director of Energy Transition. At IATA's first Aviation Energy Forum, Hemant Mistry said they discussed the pros and cons of electric versus hydrogen power, as well as government policies to support aviation's transition to more sustainable fuels. Specific policies are needed to subsidize the development of alternate fuels and decarbonize the industry over time. It's not clear yet which path the industry will take, but customers are pushing for more sustainable travel and the airlines are listening. And finally, Jeff Bezos, the founder of Amazon, shared a lesson with aspiring entrepreneurs. He said he keeps this old Businessweek cover framed in his office as a reminder. In 2006, Wall Street discouraged his risky bet to share Amazon's technical infrastructure with other companies. That risky bet turned into Amazon Web Services, and it's now the leader in cloud computing services with $62 billion in annual revenue. Wall Street doesn't like risk and unpredictability, but it's only by taking risk that we know if an innovation is a winner or a loser. As Churchill said, who dares, wins.
Here's what happened this week in travel history.
Global travel stocks are down with the rest of the market. Inflation and rising interest rates spooked investors, and no one is being spared. Even strong summer travel isn't enough to overcome the broader economic concerns. Let's take a look at the 12-month stock performance of the top global travel companies. Over the past year, the Next All Travel Index is down 18%. That stock index includes 100 global travel companies, including airlines, hotels, car rentals, travel technology, cruise lines, and more. The broader market S&P index is now down 5% versus last year. The best performing travel sector is ground transportation, up 2% since last year, as the global fall-off in auto production drives higher rental rates. Most other travel sectors are down versus last year. Cruise lines and gaming are down the most, 41% and 38% respectively. That's followed by online travel, travel technology, and airlines. Here's the 10 travel stocks that have done the best over the past year. At the top of the list is Avis Budget, up 127%. Avis stock has soared due to the scarcity of rental cars and rising prices. They're followed by eDreams 𝐓𝐡𝐢𝐬 up 27%, Ryman Hospitality up 25%, then Cathay, Qantas, Playa Hotels and Resorts, Host Hotels, Airbus, Marriott, and Apple Hospitality up 7%. On the other side, here's the 10 travel stocks that have performed the worst over the past year: LATAM Airlines, Avianca, Lyft, Penn Gaming, Uber, Trivago, Caesars, Wynn Resorts, Carnival, and JetBlue. All down 50% or more since this time last year. Currently, the world's most valuable travel-related companies are Walt Disney with a market cap of $190 billion, followed by Airbus at $89 billion, Booking at $83 billion, then Boeing, Airbnb, Marriott, Uber, Hilton, Las Vegas Sands, and Amadeus at $28 billion. Now let's take a look at the 12-month competitive share price performance of global airlines, hotels, online travel agents, travel technology companies, and more. Here's our full report on each company's relative performance.
Amadeus CEO Luis Morato reports improving results for the tech giant as European travel recovers. The CEOs of Marriott and Hilton see group business improving dramatically in the back half of the year. We have their full comments for you. A new survey by Deloitte says companies that have a strong office culture are twice as likely to reach 2019 travel levels in the next year. And in our weekly travel data update, we'll share the latest airline traffic numbers, as well as how office occupancy is recovering in major metro areas. I'm Tracy Lindley, and these are your travel industry headlines. Amadeus CEO Luis Morato reported improved first quarter results as North America bookings remained strong and European travel reopened. Bookings across the GDS and IT businesses accelerated once Omicron passed and countries began to reduce travel restrictions. In particular, the maze of European travel restrictions has been lifted, and Amadeus is a main beneficiary. GDSs price international bookings at a premium. As international travel returns, Amadeus hopes to achieve a better mix of bookings, similar to what it saw before the pandemic. But that may be a ways off, particularly with Asia. The world's largest travel IT company also continues to invest in technology. Investment priorities at Amadeus include migrating to the public cloud, expanding the hospitality platform, NDC, airline IT merchandising, and airport IT. Let's take a listen as Morato discusses Amadeus' first quarter results and the outlook for the remainder of the year. Corporate travel and groups are roaring back. That's what the CEOs at Marriott and Hilton shared in their most recent earnings calls. Tony Capuano at Marriott stated that many events that were canceled in the first quarter moved to the back half of the year. And likewise, Christopher Nassetta, Hilton CEO, said group demand was so strong in the back half of the year that rates were substantially up versus 2019. Employees that took new jobs during the pandemic are eager to meet their new colleagues in person. And businesses that haven't seen their clients for more than 2 years are eager to get back to face-to-face meetings. That's all driving a large wave of events that will keep meeting planners busy through the end of the year. Here are the specific comments from the CEOs at Marriott and Hilton.
Group demand in the U.S. and Canada accelerated sharply during the first quarter. In March, group RevPAR was 16% below 2019, compared to down more than 30% in the fourth quarter of last year. Growth in new bookings has contributed to a meaningful improvement in group pace for the remainder of the year. As of March 31st, group revenue pace for the remainder of 2022 was down in the high single-digit range compared to 2019. We also expect additional short-term bookings to further boost group revenues. April was the 8th month in a row where in-the-year, for-the-year group bookings exceeded 2019 levels. Importantly, our sales teams remain focused on driving ADR, which has continued to rise for new bookings. ADR for managed hotel bookings made in January was 3% above 2019 levels, while ADR for bookings made in March had risen to 12% above pre-pandemic levels. Business transient demand in the U.S. also gained momentum during the quarter. Recovery in March improved notably compared to the fourth quarter, with business transient room nights down 10 to 15%. Special corporate accounts, which tend to be larger companies, have recovered more slowly than smaller-sized businesses, which have now fully recovered. Special corporate new bookings strengthened in March and further advanced in April.
U.S. business transient RevPAR increased sequentially versus the fourth quarter, with March down only 9% compared to 2019 levels. Improving trends from large accounts along with continued strength from SMEs boosted results. In March, revenue from large accounts was just 12% below 2019. Overall business transient now comprises 45% of total segment mix, just 10 points shy of pre-pandemic levels. For April, overall U.S. transient booked revenue for all future periods was up 17% versus 2019 levels, with rates up 10% and room nights up 7%. Weekday booked revenue was up 9% compared to 2019, and weekend booked revenue was up 38%, driven largely by strong rate gains. On the group side, social and smaller events continued to lead recovery, while demand for company meetings and conventions improved meaningfully throughout the quarter. In March, total group RevPAR was more than 75% of 2019 levels, improving approximately 25 points versus January. Additionally, group revenue booked in the first quarter for all future periods was down just 4% relative to 2019 levels, and total lead volume for all future periods was up 3.5%. Compared to 2019, our tentative booking revenue is up significantly, with rate gains for company meetings up more than 13%. Additionally, rates on new group bookings for in-year arrivals are strong, up in the high single digits versus 2019.
A recent report from Deloitte titled Reshaping the Landscape: Corporate Travel in 2022 and Beyond details a number of trends impacting corporate travel in the year ahead. Key to forecasting the recovery of corporate travel is understanding how and when workers return to the office, as well as what travel may be replaced by technology and virtual meetings. Deloitte interviewed 150 travel managers in February, and their findings went a long ways to answering those key questions. Let's look at some of their data. Deloitte asked travel managers how soon their travel spend would return to 2019 levels. Those companies that had a culture focused around the office and getting people back in the office were twice as likely to see travel fully recover. 32% of office-dominant companies thought their travel spend would reach 2019 levels by the end of this year, while another 39% expected it to fully recover by the end of 2023. But for those companies more focused on work from home, only 12% thought their travel spend would recover this year, and only 24% next year. It will be interesting to see if those forecasts are accurate. Competitive dynamics and customer expectations may force companies to support more travel in the months ahead. Deloitte summed up their report with their Why We Fly matrix. The matrix classifies different types of travel based on how essential it is to the business and how easily it is replaced by technology. The upper right-hand quadrant is what they call the Thrive quadrant. These are the client-facing activities that are critical to the business and dependent on face-to-face interaction. In the lower left quadrant, which they label Struggle, are activities many companies believe are not essential to the business and not dependent on in-person meetings. That includes training, leadership meetings, and team meetings. But it's not clear that companies will get the engagement they need from employees sitting at home doing training and listening to leadership. It may be a few years before this settles out, and we really appreciate the value of in-person interaction. Zoom meetings are certainly here to stay, but there may be a reason Zoom's stock is down 40% this year.
Time to take a look at this week's top travel tweets from some of the most followed journalists and influencers in global travel. Reuters Business tweeted that Airbnb is checking out of China. Airbnb had struggled to crack the China market, and the strict zero-COVID policy in the market was the last straw. Local competitors in China have maintained a dominant hold on the market there. Airbnb's business is booming in other regions as they reported first quarter revenues was up 70% from last year and up 80% versus first quarter 2019. The China exit will have little impact on Airbnb's business as it made up less than 1% of their bookings. Seema Modi with CNBC shared her story that Carnival may sell its seaborne luxury cruise brand to the Saudi Sovereign Wealth Fund. Talks between the two parties are ongoing. A deal of this size would give the Saudis a greater footprint in the cruise industry at a time when travel continues to rebound across the Middle East. The Saudi Wealth Fund already owns 5% of Carnival after buying a stake at the peak of the pandemic in 2020. The Illinois Hotel and Lodging Association shared this article from Hotel Business. 46% of Americans are planning a trip involving hotel stays or other lodging. That number would have been high before the pandemic, but it's particularly strong considering rising virus cases and surging inflation. Almost 3 in 10 travelers plan to spend more than they did 2019 due to rising airfares and room rates. Most of the travel will be domestic as just 15% of Americans plan to take an international flight this year. The Seattle Times tweeted their article on Alaska Airlines pilots authorizing a strike if contract talks fail. 96% of pilots voted and 99% authorized the union's leaders to call a strike if necessary. The union has been pressing for years to address concerns with work rules, scheduling flexibility, and career security. But a strike would only take place after a prolonged negotiation and cooling-off period. Expect the two sides to come to an agreement well before disrupting service. And finally, Dawn Gilbertson with the Wall Street Journal shared her summer travel survival tips. Travel suppliers will be challenged this year to meet a surge in demand with limited staffing. Best to be prepared. Gilbertson recommends doing all possible to avoid airport lines. That means using the Airlines app for rebooking, ensuring you're enrolled in rental car loyalty programs to avoid the counter, and even reserving a spot in the airport security line if it's offered. Forewarned is forearmed, as they say. Make sure you have a plan B for this crazy summer travel season.
Here's what happened this week in travel history.
U.S. travel indicators are holding steady as we head into the summer. Airline traffic is still down about 10% from pre-pandemic levels. Office occupancy, a leading indicator of business travel, remains low and virus cases are rising. But none of that is holding travelers back as we roar into summer. Let's take a look at some of the key travel industry data. Here's the latest passenger data from the U.S. Transportation Security Administration, or TSA. 2021 and 2022 numbers are shown in orange and 2019 passenger counts are in blue. The 7-day rolling average is now down 9% from 2019 levels. That's almost the same level as last week, but forward booking data suggests the gap may close soon. Delta, United, and American all stated demand was as strong as they've ever seen it. Virus cases are down 87% from the peak of the Omicron wave in mid-January, and fewer travelers have health concerns. But the latest variant has case counts rising again. Versus last week, cases were up 10%, but that's on a low base. Fortunately, deaths and hospitalizations remain at low levels. U.S. office occupancy rates, a leading indicator of business travel recovery, are stuck at about 43%. While they're up from earlier in the year, they are not improving quickly. With the tight labor market, many companies have had difficulty getting workers into the office. That doesn't look like it's going to change anytime soon. But the story is different by U.S. region. Texas, with its more aggressive reopenings and business culture, is leading the country in occupancy. Austin is at the top of the list at 61%, followed by Houston and Dallas, both over 50%. The average office occupancy in the country is 43%. At the bottom of the list are San Jose, San Francisco, and Philadelphia, all at 38% or less occupancy. U.S. vaccination rates have leveled off now, with 221 million, or 67% of the U.S. population vaccinated. Seniors 65 years and older, the most vulnerable segment, are 91% fully vaccinated. That builds confidence for long-delayed family reunions, vacations, and group meetings and events. Medical experts believe the high vaccination rates and a wide base of natural immunity will also reduce the impact of the latest Omicron variant. Based on the strong sales data reported by U.S. Airlines, traffic should see a significant bounce back this summer. We forecast that U.S. airline passengers will be down just 5% by early June and then reach, if not exceed, 2019 levels this summer. Massive pent-up demand along with record consumer savings are fueling a strong summer travel season. We'll update our forecast each week as more data becomes available.